Welcome back to the deep dive. So today we're really getting into the UK property market data. We're pulling apart the latest ONS figures, that's the Office for National Statistics, for August and, well, into September 2025. And the big thing, the headline really, is that UK house price growth annually, it's slowing down, dipped to 3.0% nationally. But here's the kicker, the really surprising bit. London. It's the only place in England where average values are actually dropping year on year, down narrow 0.3%.
Yeah, it's a stark difference, isn't it? A real divergence. And that's kind of our mission today, right? To unpack why we're seeing this almost two-speed market develop. You've got resilience up north, but things stalling, particularly in the south. And, what policy jitters are behind all this caution?
Okay, let's ground ourselves in the numbers first. Nationally, average UK house price. It's sitting around £273,000. But like you said, that average figure, it really hides what's going on regionally. It's fractured.
Absolutely. And England itself tells quite a story. Look at the Northeast, it's actually powering ahead. Highest annual price inflation there, 6.6%, which, suggests affordability is really playing a role, driving that local demand.
Right.
Now, contrast that directly with London, that 0.3% fall. It just highlights the headwinds down south, especially at the higher end. You've got more properties listed, maybe, and people are super sensitive to things like stamp duty.
And it's not just England, is it? Prices are, holding up elsewhere, too.
Yeah, that's right. Scotland saw 4.0% annual growth. Wales was a bit lower at 2.0%. And Northern Ireland, actually, they did pretty well in Q2, up 5.5%.
That regional split is, wow, it's really something. But it's not just about buying and selling, is it? This pressure, this shift. It's hitting the rental market, too. We're seeing movement there as well. The UK average private rent, latest figures for September, hit £4,354 a month. That's up 5.5% on the year. About what, £7 more?
It is. But, and this is quite fascinating, while rents are still high, definitely high, the rate of that increase, the annual inflation figure, has actually been easing for 9 months straight now. So there's a clear deceleration happening.
Okay, so slowing down but still going up.
Exactly. And regionally, again, the Northeast led the way on rental inflation too, up 9.1%. But look at Scotland, their annual rise, 3.4%, was the lowest they've seen in over 3 years. It's been generally slowing there since that peak back in August 23.
So right, we've got this north-south thing in sales, slowing national growth overall, and rent's still rising, but maybe not as fast. Why? Why is the market, especially the sales side, acting so, cautiously? Even if some buyers are maybe tempted back by slightly more stable mortgage rates.
Well, that's the £1,000,000 question, isn't it? Or maybe the £273,000 question.
Maybe.
Look, the main factor, according to most experts we're reading, it boils down to policy uncertainty. Specifically, everyone's got one eye on the upcoming autumn budget.
The budget.
Yeah. And that uncertainty, it seems to be creating this two-speed market you mentioned. You've got people who have to move maybe for jobs, family reasons, whatever. They're still out there, but they're negotiating really hard. Apparently, viewings are less like viewings and more like, interrogations.
Okay. So the must-movers are driving hard bargains. What about everyone else?
Well, the discretionary movers, particularly those looking at higher value properties, they seem to be adopting this wait-and-see approach, just pausing things until they get some clarity from the budget, maybe fears about capital gains tax changes or stamp duty tweaks. It's enough to make them hold off.
So they're just postponing the decision, essentially, waiting for the dust to settle post-budget.
Precisely. And let's not forget the affordability challenge that underpins everything. It's still a huge hurdle. CPI inflation, it's, stubbornly high at 3.8%. That's nearly double the Bank of England's target, remember?
Yeah, still sticky.
And while mortgage rates have stabilized a bit, they're coming down very, very slowly. That naturally puts a lid on how much prices can rise. Plus, add in the fact that we've apparently got the highest level of homes listed for sale in about a decade this year.
Wow, a decade high.
Yeah. That gives buyers who are active a lot more choice and, more negotiating power. They can push for those price reductions.
Okay, so pulling all these threads together, what's the key takeaway for you listening right now?
I think it's that the market currently seems less driven by the usual housing fundamentals, supply, demand, basic need, and much more by this anticipation. This waiting game related to potential tax and policy shifts down the line.
So it's all eyes on the chancellor, basically.
Pretty much, especially for the prime market, London particularly. It feels like it's in, suspended animation until after the autumn budget clears things up.
Which leads to the final thought, I suppose.
Yeah, the really interesting question is what happens next? When that clarity finally arrives, probably in the new year, do we see this massive rush of pent-up demand flooding back in? Or has this period of caution, combined with high supply and those stubborn interest rates, actually set a new, more subdued norm for the market going forward? That's what we'll be watching.